All right, guys, thank you so much for your patience. So today we have an amazing individual, Yonah. How are you doing, Yonah?
Doing pretty well. Thank you. Thank you. Thanks for having me.
Awesome, awesome. He's going to explain to us a few of the benefits with Madison Specs. We know that a lot of you guys listening who are working professionals, sometimes you guys have heavy tax bills or tax burdens at the end of the year. And so if you want to figure out a way to make it mesh or connect when it comes to real estate investing and alleviating some of that tax burden, then listen up very, very closely. All right. So Yonah, first, can you kind of just let us know the type of clients that you work with and who gets the biggest benefit with working with your company?
So typically speaking, and just for a little clarity, we do something called cost segregation, right? So it's a tax benefit specifically for real estate owners. The people I work with the most are real estate investors, real estate owners. But those who benefit the most are those who are full-time real estate professionals, meaning either you or your spouse, only one of you needs to have this status, but that means you're working full-time in the real estate trader business, whether that be owning properties, managing, operating, acquiring, brokering, developing, anything like that. Anything of those occupations, you actually get special tax treatment from the IRS that allows you to not just get huge tax deductions, but actually be able to use them to the maximum benefit, as opposed to just maybe creating losses, which happens to a lot of people.
Okay. And so when it comes to using those benefits as an investor, what could I use that money for in the future? How could that help me? How could that help me expand my portfolio?
Well, it really helps you more than in the future. It helps you in the present more than anything, because what everyone knows, the largest expense that any individual or business has is your tax bill, your income tax bill. And with accelerating depreciation through cost segregation, which is essentially what we do, it allows you to offset or eliminate your tax liability, your income tax liability. However, unless you're that real estate professional, it's going to be limited to your rental property income. So if you own properties, if you own, or you have a business that owns a property, rental properties, you can use that depreciation to totally eliminate your rental property income. Right? So that's what's really going to benefit you now in the present. That's freeing up all of that cash flow to then reinvest and make money on your money.
Awesome.
Have your money make money.
Awesome. And Hank, you can hop in whenever. I know I'm talking a lot already, so feel free.
No problem. A question I have is, does what you're talking about, does that apply to either new market tax credit products or low-income housing tax credit products?
Any of the above, right? Any type of investment property or business property has depreciation benefits and can get huge tax deductions through that. So it doesn't necessarily depend on the tax credits. Will maybe be coming from other places. Tax credits will definitely be coming potentially to help with property tax as well, and other things like that.
Well, speaking of the property tax, some of the new market tax credit or low-income housing tax credits might have sort of like a reduced property tax scale for about 10 years. Okay. And the exact terminology escapes me right now, but what I'm hearing you say is that just helps to put extra money in your pocket. Am I reading you properly?
Right, exactly. So there are many different strategies to be able to lower your taxes. What we do is specifically talking about income tax. So, you will still be having tax, property tax, things, and there are income, credits like that can help you out in different types of property tax, abatements and things. But what we do is something totally different. So if you can knock it off, knock down taxes in many different areas, then I think it's a great way to do it.
Oh, okay. I understand.
Awesome. So for example, Is this something, so you have to be a full-time investor, I understand that. Is this something that someone with a larger portfolio will benefit the most from, or could this also help those who are just getting over their first or second acquisition?
It can help anyone. It can help anyone, even in their first or second acquisition. It will help, the more property you have and the more money you're making, the more it's going to benefit you, right? Because the more income tax savings you can have, the better. And the more properties you have and the more expensive the properties are, the more potential tax benefits you can get from that. So, you talk about people like, President Trump and, Jared Kushner and the news and everything like that. And it's getting a bad image that they're somehow not paying taxes, right? They're gaming the system. But it's not. It's right there in black and white in the tax code. You just have to be smart enough or have, smart enough accountants or to be able to take advantage of those deductions. And a lot of it just is because people don't know about it. They don't know that they exist, and accountants are not proactive enough to actually, do that for you. So, it's in there. So the more, again, people like, that's how probably the majority of real estate, moguls, big real estate investors have been able to scale their businesses through not just the income and the appreciation, but more importantly, doing it all without having to pay taxes.
Yes. And just so that everyone can hear, nothing illegal is taking place. This is all legal. Okay. Despite how you feel about different people, they're playing by the rules. Nothing's illegal. This is just part of the tax code, and the tax code can change every day, right? With your company, when did you guys notice that this was a big opportunity or a problem that people weren't taking advantage of?
Well, it's been around in the tax code for the past, 30, 40 years. It's taken, different stages along the way, but we've been around for about 15 years, and the founders of our company were in the industry and doing it for tax firms, for accounting firms, large accounting firms that were doing it in-house. So the largest accounting firms were doing it in-house, and we're basically helping the biggest corporations and the biggest people, doing this. And the small fish didn't really know about it. And what I've found over the past few years that I've been doing this is that a lot of new investors, people that are getting involved, and a lot of people are, of late have been interested in real estate and finding in, alternative assets, alternative investments, seeing ways to, maybe diversify their portfolio of investments. And they still don't know about cost segregation because it's like this one tiny little piece of the puzzle. And so what I've done, focused on, is just trying to educate, the masses at large. And it's been very successful.
Awesome.
My question is for the little guy that's getting into real estate. The big guys, okay, they know all about the bells and the whistles, but approximately how much would the analysis or the segregation study or analysis, roughly how much would it cost a person to do that?
Sure. So it depends on the type of property, the size and shape of property, not necessarily on the tax benefits. It's not a contingency fee like some other tax, saving products out there, some property tax savings. People will charge you a percentage of your savings. We have a flat rate, and it's usually a few $1,000s to get the study done minimally. Mm-hmm. So somewhere between, $3,000 and $6,000, depending on the size of the property. And this can be done from, single families all the way up to, like the skyscrapers behind me, right? We've done plenty of those. And so it really starts to make sense when you do the math, and we're talking about how much, maybe 20% of your purchase price you can take as a upfront tax deduction. Wow. It really starts to make sense when you're, the bigger property is, right? If it's just a $50,000, single family rental, you're not going to get much out of that, right? You may get a few $1,000s of tax benefit, but you're going to pay a few thousand to get the study done. It doesn't make sense, right? So my rule of thumb is usually any property purchased for over $500,000, that's where you see, major, like 10x benefit. Below that, you still may find benefit, and it's worthwhile to look into. We provide a free estimate for any property, so you can already see upfront, what you can expect if you were to decide to do a cost segregation study. So it's definitely worthwhile to look into.
Approximately how long will it take? Typically, how long does it take to, and I know it'll probably depend on the size of the product or project, but typically how many, 2 or 3 weeks, 3 or 4 weeks?
Yeah, exactly. Typically about 3 to 4 weeks for us to turn it around. And it does involve a site visit. So we have engineers in-house that go and actually do the site visit. They'll come to the property, analyze everything, take pictures, measurements of everything in the building, and be able, to take that and now apply that with the tax code to see how much can be depreciated faster.
Well, a lot of new investors are using relationships that they currently have. They probably already have an accountant or someone that calls himself an accountant, no disrespect, someone who may or may not be a CPA, and they may have someone who called themselves a contractor who may not be the type of engineer that's required to do what you're talking about. Is there any special training that either the accountant or the engineer needs to have if they couldn't use you, but they were still trying to take advantage of what you present here today?
So it's really what makes it so special is that it's a combination of the two, right? You're correct. There's accountant, it's an accounting method that's involved, and it's an engineering method that's involved, but it's really the marriage of the two together that makes the magic happen. So accountants can't do this on their own. They need that engineering component to it. Engineers can't do it because they need to understand the tax code and how it applies. So there is special training that's involved. There's no specific certification per se, but the engineers and the staff that's been working with us have been doing this for a long time, and those engineers that come on board are trained, very, especially to understand how this all works and how to apply the tax code. So it is a niche thing. There are many, like I mentioned, when our founders started the company, they were coming from the accounting world. So they were the largest accounting firms in the country, the big four, right? They all do this in-house. They have engineers in-house and they provide this as a service. They also charge like 5 times as much to do it, but they don't care because you're paying them a lot of money anyways. But yeah, you do need, that's why firms like ours exist. And there are a handful of national firms like us out there doing this because it is such a niche kind of service.
So quick question. So a client goes ahead and purchases $1 million, say, let's call it an apartment building. Year 3, they go ahead and do some capital expenditures. So on year one when they purchase, at what point can they use cost segregation into it, segmentation into it?
So there's really 2 stages. There is the cost segregation on the acquisition, and this is really the most amazing part. We actually look at the purchase price, and we look at everything that's in the building as is when you buy it. And now you're able to accelerate the depreciation of some of those personal properties, some of the assets in the building, to get that tax benefit right in the first year. Now, when you go ahead and do renovations, maybe a year in, 2-3 years in, the CapEx, you can now get that money spent, you can get that segregated, and you can actually take the deductions of that as well as a faster tax deduction. So you can really double dip when you're doing it that way.
That is awesome. And then let's say in year 5, exit strategies, a refinance. Will we have any benefits with us refinancing?
Not specifically to cost segregation, because the depreciation is set in stone the day you buy the property. It's based on your purchase price. Okay. Even if you bought a totally undervalued building, but your purchase price establishes what your tax basis is, it's called. So that's your depreciation. The only time that changes is when you add more money into the property. So like you said, like the CapEx. Now, what's amazing about that is that it takes into consideration money that was spent through financing the property. So it's not about how much money you actually took out of pocket. it's based on how much money was spent. So the bank could be paying for 80%, or you can get seller finance and get 100% someone else to pay for it, and you get the tax deductions based on that purchase price. When you refinance, it doesn't change your tax basis. The one good thing of, not one good thing, there's many good things about a refinancing, but one thing that a lot of people don't realize is that the money, and again, this isn't related to cost segregation specifically, but it is tax related. The money that you get from the proceeds of that refinance, if you cash out, that money is not taxable income. Okay. So you, like if you refinance and get a cash out refi and take $100,000, that's not taxable income. Okay. So that's all yours.
So let me make sure that I understand. So if we were to take money out, then we dispose of the building, so we don't have to deal with a capital gains tax on that aspect, or on the whole product?
Let me understand your question again. You're talking about selling the building now?
Yeah, disposing of it.
So yeah, when you sell a building, you have capital gains tax. Correct. If you made a profit on the sale. Okay.
Mm-hmm.
So I was talking about doing a refinance and taking cash out that you can that you can get the cash out that you get from the bank. That's considered borrowed money, or was originally borrowed money, and so therefore that money is not considered income. That's taxable.
Yeah. So that would be, but so essentially what we just talked about on a 5-year schedule, that would be a really good strategy for someone as far as lowering their tax liability. Yeah,
huge. And again, you mentioned before, it has to do with, people who have multiple buildings. It's a strategy that works best when you're using depreciation from one building to offset income from multiple buildings, right? So if your strategy is to continue growing, this is the best way to keep your tax liability down as you reinvest and buy more.
Fantastic. That is awesome. That is so awesome. Yes.
I think I talked about building today.
That is awesome. Seriously. Yeah, that's great. Okay. So for everyone who's listening, Yonah, where can they find more about you and sign up and all that good stuff?
Best way to find me is actually on LinkedIn. I'm very active on that platform. Love it there. So if you're listening to this, shoot me a quick message, connect with me that you listen to this podcast, to this episode over here. And but you can go to yonahweiss.com. That's my website. It has a link directly to our company's website as well, Madison Specs, but you can actually fill out a form there to get a free analysis, a free quote for your property to see what the benefits would be. So go ahead and check that out.
Fantastic. I'll put that in the notes. Hank, any questions before we let Yonah go?
No, I'm actually I'm overwhelmed or excited about the possibilities. Because when we were looking at developing a hotel, we didn't know any of this existed. We were just looking at normal straight line depreciation. We weren't looking at too much at accelerated depreciation on steroids. And it's like, dang, where were these guys when I really needed them?
Yeah.
But obviously I didn't need them then. I need them now.
Yeah. So awesome. Awesome. Yonah, thank you so much. And we're looking forward to it. Thank you a lot. We're going to definitely get people into this because people do need this a lot.
Okay, my pleasure.
Including Hank. So
yeah, absolutely. Thank you so much. I really appreciate it.